Yeah, we're negative on the stock market. We're very positive on the monetary metals. We think in the next 5 to 6 months, you're going to see, for example, gold continue up, but silver explode. I think silver has a very strong chance between now and year end of taking out the old dual highs at $50. I guess they're phantom highs anyway. They were hardly up there at all in terms of duration. And going into the $60, $70 range. And I'm not saying that's a top. I'm just saying that's the next pause point maybe. But I think that the important part is the surge. I think silver could basically double. That's what I'm saying over the next 6 months. Now, gold will go up nicely too, but silver will outpace gold on a percent basis. So that personally, that's my focus.
Silver shined in June, returning almost 10% and beating out the returns delivered by the stock and bond markets in Japan, Europe, and the US. The momentum could continue as July brings favorable returns for the precious metal. Going forward, the World Bank expects silver demand to remain robust, supported by the gray metal's dual role as both an industrial input and a safe haven asset. Market analyst MichaelOliver projects a strong bullish phase for monetary metals, with silver expected to outperform gold in the coming months. Despite recent selling pressure, silver's resilience signals the potential for its price to double, reaching up to $70 within 5 to 6 months. Silver also maintained its strong momentum in 2024. Even with strong silver price gains, the gold-to-silver price ratio climbed further above its 10-year average in early 2025, continuing its steady upward trend, the World Bank noted. The technical setup, macroeconomic tailwinds, and analyst bullishness all indicate that silver is expected to outperform gold in the third quarter of 2025. With its undervalued ratio, supply deficit, and EV-driven industrial demand, silver is poised to shine. Based on ongoing trends, Oliver also discusses technical patterns showing that both gold and silver miners are breaking out of multi-year bases. Despite strong gains, mining stocks may still be in the early stages of their bull run. GDX saw $3 billion in outflows this year, with real inflows only starting recently. Many top miners have yet to join the rally, hinting at further upside as broader investor interest grows. A notable bifurcation exists within the mining sector, where some stocks have doubled or tripled in value year to date, while other high-quality companies have barely moved. This disparity creates potential opportunities for investors to identify undervalued gold stocks that have yet to participate in the sector's broader advance. Before we dive into MichaelOliver's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Yeah, we're negative on the stock market. We're very positive on the monetary metals. We think in the next 5 to 6 months, you're going to see, for example, gold continue up, but silver explode.
It looks like it's already exploding today, and we're up to 36.50 today. It's up almost 50 cents.
Yeah, no, that's you're using the spot contract there, I think. Or spot. Yeah. We use September silver right now, and September is trading at 36.70 something. But you'll see the explosion that occurred in April, and it blew through the two $35 highs that existed. Mm-hmm. One was in last October, and then there was a $35 high in March. Those two peaks, yeah. So double top. They tried to break down hard in early April, trying to act like they're the stock market, which they're not. Silver follows gold and always does. Exploded through those highs and has held its ground despite constant selling for the last 4 weeks or so. I think you touch 37 again and you're going to be gone. Or is they're going to realize this isn't topping. This is just a pause. I think silver has a very strong chance between now and year end of taking out the old dual highs at $50. I guess they're phantom highs anyway. They were hardly up there at all in terms of duration. And going into the $60, $70 range. And I'm not saying that's a top. I'm just saying that's the next pause point maybe. But I think that the important part is the surge. I think silver could basically double. That's what I'm saying over the next 6 months. Now, gold will go up nicely too, but silver will outpace gold on a percent basis. So that personally, that's my focus. In other words, if this were a price chart and you know it's not going to zero, what do you think about here? Are you bearish, or you look, hey, maybe this is a bargain? Okay, it ain't going to go to zero. Okay, and I think that next upturn could easily take you up to there. You've got it expressed the way we do, yeah, to the 2% level easily. In fact, if you go back, you go back quite a ways here. The number of the past 50 years, going back to the mid 70s, where we get up there to 6.5%, silver has reached 2% in 21 of those 50 years. So it's almost routine to be at least 2%.
Right.
And we're right now 1.09 Okay, or almost 1.1%. So it could double in relative performance just to get to the 2% level, which isn't that's not even a big achievement.
And that's assuming gold stays constant.
Gold's going up during that time.
Mm-hmm.
It's just that silver's going to go up. Instead of being 1% of the price of gold, it'll go to 2%. Because whenever the spread goes up, by the way, the metals both go up. It's never a case that silver doesn't go down and gold goes down more. It's always the case that when this spread rises, silver is going up more than gold. Just to get to the 2% level, which is a so what level, anyway, I think that's about to occur. And suddenly, I don't think it's going to be incremental, which means if you're not in there, you could miss it. It could be a move that you don't believe. That's my emphasis personally in my own investing right now, is to focus on the next 5 or so months and silver. And also the gold miners and silver miners. I think they're about to shift into outperform mode versus gold.
Okay, so GDX
or XAU, either one. Yeah. Price of GDX, you can see if you go back to the 2011 top, go further to the left there, you'll see that first drop, that hard drop off the high, stop there in the 40s, and then you rallied hard, failed. But if you draw a horizontal through that first major low, it basically capped off the last couple. Yeah, right there. You draw that line. Yeah, right about there. That was resistance, meaning where the old pivotal low was prior to the real collapse is where you kept getting selling. Well, you've broken through that. Even price is saying, hey, game's on, boys. We said it earlier than that based on momentum, but price is now echoing that. And I think in the next 6 months or so, those old highs of 2011 are coming out in GDX, meaning you're going to be up in the 70, 80 level. Silver, well, not so much relative to silver, but silver miners relative to gold miners, we see breakout potential there too. So yeah, we think the silver miners are a place to be. In fact, personally, that's my emphasis.
So SIL relative to GDX, or do you use SLH?
You can use SIL versus GDX. Yeah, that'll be good.
Yeah, so
you can see really that since 2020, there was a low prior to that big shot up. But basically, you've been going sideways, slightly lower lows. Because look where you are right now on the spread. Draw a line back sideways. You were there in 2022. So 3 years ago, you were at the same level you are now. So right now, at the current price of SIL, yeah, you can draw a channel there too if you want. Do it across the highs now. Take that same line. No. Take that bottom line. Make a parallel line off that bottom line and plot it through the highs. Yeah, just draw that line up. Take it upstairs. Yeah, there you go. And run it across that peak in July of 2022. Yeah, there you go. Carry it down. We're in a channel, okay?
Yep.
Now, right now, you're in the middle of it, meaning versus 2 years ago, you are where you were then. So meaning that silver miners right now are doing just as well as GDX did since mid-2022. Yeah, they've been better than that and worse than that, but basically it's a bottoming pattern. And you go through the top of that channel, you're going to likely shoot back up to that 140 level or so. But treat this as a basing pattern. And you can see the last 2 months, there's been quite a bit of firming here. Silver miners relative to gold miners. By the way, in GDX, there are about a half dozen significant silver miners. So it does have some, but it's mainly gold miners.
Gotcha.
Yeah. So it's a place to be, I think. Where you want to be the next 6 months, not the stock market. You want to be in monetary metals, but especially the silver side of the equation.
In the interview, MichaelOliver emphasizes that Treasury yields remain stubbornly high, unlike in past crises, despite stock market weakness. A brief bond rally in April was quickly erased, showing bonds no longer act as a safe haven. Oliver concludes, gold is now the only viable alternative. For decades, gold and bonds have traded closely together almost all the time. However, gold has recently trounced bonds to an extent not witnessed since the 1970s. In the past, rising interest rate expectations have been bad news for both bonds and gold. So, the fact that gold is strongly outperforming during a period when U.S. interest rate expectations have risen dramatically is extremely unusual. Recently, 10-year Treasury yields have dropped to 3.8%, reducing the relative appeal of bonds and diverting capital to gold. According to MichaelOliver, significant political and economic shifts are ahead. Meanwhile, he is maximally bearish on the dollar index, warning that its decline could hit foreign investors and weaken U.S. markets. The United States dollar has experienced its worst first 6 months of the year since 1973, as President Donald Trump's economic policies have prompted global investors to sell their holdings of the greenback, threatening the currency's safe haven status. Let's get back to the interview.
30-year yield futures, top one.
Oh,
you had it there. It said 30-year. Hey, okay, this is yield. Okay, that's fine. The price charts, see, you're back at levels of 2000, you're going back 25, 26 years. You're at those levels, okay? Whereas you had rates real low, now you got them reasonably high and not dropping. They're clustered up there for now 2.5 to 3 years at those levels, which is like a noose around a lot of debtors' necks. It's not getting easier. It's staying tight. And your debts are coming due now, like commercial real estate. So again, this is a factor that you need to watch, because the government bond market normally, whenever the stock market gets wobbly and asset managers perceive greater risk, less reward potential, they move over to the T-bonds. They did it in 2000 to 2002, 2007 to 2009. They bought T-bonds. Yields went down. Okay. Look at the stock market had this horrible break in April, but the yields didn't, there was no relief in this market. This market remained at choking interest rate level highs. And so, as Jamie Dimon has said, the underlying problem, the government debt problem, not private debt, now we're talking government debt, is this time ain't going to go away. This time there's a crisis pending. Something's going to happen. And it's probably not good. Well, or maybe it is good because it's a remedy. Sometimes when you're sick, you have to throw up. But this market's not behaving as an alternative to a weak stock market. It tried to. Back in April, there was a rally. You don't see it on these bars, but there was a rally that took T-bonds from 114 price level up to 111 price level up to 121. And in the first week of April, get a price chart anywhere? Anyway.
Yeah, it's all yields.
Oh, it's all yields. Okay, anyway. Where you had a rally in bonds from a 10-point rally in the T-bonds, which is a big drop in yields. And they collapsed it all back up in 2 days. In other words, bonds crashed in price. Yields went right back up, erasing a multi-month rally in 2 days. So the potential alternative that T-bonds offered, you got kicked in the gut if you went to that alternative. What's the other alternative? It's always been gold. Elon Musk was your Doge guy, and now he wants to create a new party. Innovative guy, probably not a bad idea. But anyway, the point being, there'll be a lot of things exterior to the markets that will be occurring. Probably some of them revealing themselves in the next 6 months. But over the next couple of years, my bet is there will be a Fed, that it will cease to have its sense of legitimacy, acceptability on the part of intellectuals and economists will say, really, this hasn't been working. You guys do monetary boom bust, it creates stock market boom bust, and you're not in control of anything. Another thing might happen. I'm not advocating, I'm just looking at it above. No income tax. Trump's mentioned that. That's not the issue. The issue is the ability of the public to pay. Because if you go into a spiral like I'm talking about, and you put us back in unemployment again, like remember 2008 and 9, people who weren't in the stock market were devastated, not just the stock market holders. Already, the IRS isn't bringing in the percentage of money, the revenue they're expected to bring in. So many people requesting delays, plans, simply not filing, et cetera. There'll be a point at which the federal government will simply make a decision that it's dysfunctional as an income source for us. We're going to go to a national sales tax or something. So all kinds of things could happen like that. The party system already is in question. For decades, it's been this one, that one, this one, that one, and yet nothing really changes. Government grows, it grows, it grows. Debt grows, grows, grows. All of a sudden, the Democrat Party is in shambles, possibly to reorganize in some way that we can't imagine, like extreme left version of it. Moderate version, but fragmented. Republican Party could easily become fragmented. Ron Paul, for example, is an intellectual. Rand Paul, his son, Rand Paul, who is influenced with major ideas, not just political notions. is a big opponent to what's going on, just like Musk is in terms of the deficit spending and so forth that is ongoing. There's guys like him that don't quite latch on to the Trump movement. So I could easily see, especially if certain things happen that aren't supposed to happen, like commodity inflation comes back. Well, why is that happening? Trump, et cetera, that you could have fragmentation there. So maybe the two-party system will evolve into something else, like a multi-party system they have in a lot of countries, very fragmented. All kinds of changes like that could occur exterior to the markets and are likely to occur, because I think these market events are going to be very impactful. Dollar index. Dollar index has been dull, dead quiet between 2023, 2024, and even into early part of this year, where you could, if you got a chart of the dollar index, you could see it. Yeah. You had that run up into 2015, and then you dropped hard into 2023 through 2024, and you stayed in a narrow little range. It was about 8% wide for 2 years. When they tried to break out of it, we put out a report saying, don't trust the rally. It's a breakout on the price chart, but it's baloney. It won't sustain. But it didn't. In March, the first hard month off that high, we went major bearish, because you've got a trend line here on price, but we had one on momentum that broke way up there at 104 level.
Okay.
That was being March. Okay. We dropped down to 124 close was that month. And then you dropped hard into April, May. June is now blown through your price trend line there. But it's also blown out another annual momentum structure at that point. We're maximally bearish on the dollar index. But what's happened here is here's a major factor in markets, the Forex exchange rates. This is primarily, the dollar index is primarily the euro and the yen. Combined, they constitute 70% of the dollar index. Okay. But there's nothing been going on between 23 and 24 in terms of any volatility. So it was not a wave maker. It didn't have impact in other markets. Now, I understand that foreign investment in the U.S. stock market over the last few years has grown to levels it's never been before, very high. But they are affected by not just the price of the S&P, but by, they took the euro and the yen and bought dollars and bought our stocks. Okay, so they're dollar vulnerable. So if the dollar suddenly drops from where we said sell it at 104 in March, 104. It's now down to 96. That's starting to have an impact on somebody who holds assets in the U.S. Forget whether that asset went up or down, but suddenly you've chopped that much off the conversion value of that asset. Right. So that could help weaken the stock market, and also maybe people who own long U.S. government debt market. They're being impacted by this. While the bonds are sideways at a strangle level, in conversion terms to a yen or to a euro, you're getting hurt.
Many analysts believe silver has room to go higher. Citi Research recently forecasted that silver could reach $40 per ounce within the next 6 to 12 months and possibly $46 by the third quarter of this year if the momentum continues. However, short-term pullbacks are still possible, especially if gold continues to weaken. Are you prepared to adjust your portfolio as gold, silver, and mining stocks take center stage in a rapidly evolving financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.